Nation of the On the Mark Financial Forum and podcast. We are excited today to have our guest speaker, co-host, Christian Hutchins. Thank you so much, Christian, for joining us. And we're going to do something new today. So we're going to have a little raffle. So anybody who shares this on their profile, sends an email to a friend, tags us on Instagram, or shares this to their network on LinkedIn, please email us or DM us a copy of what you sent, and we will enter you for a $25 Amazon gift card that we'll be doing a drawing for on August 1st. Which will be aired on Instagram as well. So we want to encourage more people to get to know about this and be able to share the knowledge that we're learning. So our teacher of the day today, Christian, thank you so much for joining us. Maybe you can tell the group a little bit about yourself.
Absolutely, a pleasure to be here. I'm Christian Hutchins, wealth manager out of Los Angeles, originally from North Carolina. Even though we moved out here when I was fairly young, when you're raised by Southern parents, you're pretty Southern at heart. Living in Manhattan Beach now, which is a hard place to beat. Offices here in LA, working with all types of folks. Being in LA, we have a decent amount of creative clients. And then, I'd say about 50% of the clientele that I work with are business owners, whether they be highly skilled in a certain area, like whether it be real estate agents, whether it be doctors, but they have kind of like that through line of owning their own business or being a partner in a practice, which comes with its own complexities, but also significant benefits. Yeah,
absolutely. There's so many components of that that are so important to discuss. So maybe we'll have you on another future session. But today's topic is specifically about retirement planning and the unique characteristics of retirement planning, specifically for self-employed, but that, in my opinion, also includes people who just have variable income, where their income can go up and down. I'm definitely in that boat, so I'm looking forward to hearing what you have to say, because my business is seasonal, it's cyclical, it's we're seeing high interest rates right now, and obviously business is not as busy as it was when rates were under 3%. So I experienced some of these same challenges myself, and that's one of the reasons I'm excited to have you talk. And you mentioned real estate agents as well. I know a lot of our community is the real estate community, and so I think some of the insights you're going to be able to provide will definitely give some guidance to people in my sphere, and have it apply to people who are self-employed or variable income earners as well. And one additional segment that kind of comes to mind as far as what's happening right now is, you're in LA, so I'm sure you deal with a lot of entertainment clients. There's two strikes going on, as if one weren't enough. There's two strikes going on, and people may be rethinking how they approach retirement, among other things, and just paying everyday expenses, because Hollywood's more or less shut down for a while, and it might be a little bit. So this topic really applies to anyone in this sphere, whether it be entertainment or real estate or anything else, any kind of business owners. So maybe you can just give us a quick overview. Like, what do you think it is about retirement planning that makes it unique specifically for people in those environments?
Yeah, I think the beauty of being a business owner is you have control, right? That's why a lot of people go into it. But unfortunately, with that comes a lot of things that you really don't want control over, right? There was the benefits of having HR when you were an employee somewhere that would handle your benefits, would have the 401k already set up. Oftentimes, you didn't even have to put money into it for it to get money deposited. So when you're a business owner, there's nobody doing that. And so there's that added complexity and responsibility that you have to do yourself. And then you're also thinking about the 9 million other things that are going on in your day-to-day that gets in the way. So you take that, and then you take a lot of these businesses where I have a lot of clients who are in the industrial or manufacturing businesses or aerospace, where they have recurring orders and they kind of have an idea of what revenue is going to look like. That's a little bit easier because you can do projections and you know what you can put away, you know what you're going to take as a salary. And then you compare that to whether it be the creative who has projects maybe once a year, or the real estate agent that closes on a couple of opportunities a year, if not more. it's a lot more responsibility, and the puck is always moving. And if you're not skating to where it's going to be, you'll be caught off guard. So, one thing we always say is pay yourself first, right? Easier said than done. And a lot of people don't really know, well, how exactly am I doing that? Am I just putting in my checking account? Because that feels like I paid myself. So a lot of it is building the structures you need and setting kind of very simple processes for yourself. And Mark, you and I have talked about this of, sometimes it's just as simple as having a 30-30-40 type of approach where 30% of your money is set aside for taxes. Now, granted, we live in California, maybe that number is 40%. 30% is set aside for your life. And then maybe 40 or 30% is set aside for savings. And that savings bucket is not just for cash going into your savings account. It allows you to dip into that for these types of retirement plans that we'll touch on here in a second.
Right. And it sounds like that would be difficult in let's use real estate as an example. There's not as many transactions happening right now as there were a couple of years ago. So it'd be more difficult to put that 30% toward savings, and when there's less overall. So how do you adjust that? Like, how do you work with your clients to kind of adjust based on what's happening in their world?
So the beauty of the vast majority of retirement plans are adaptable to what's happening in your life. So you can start a SEP IRA or a traditional IRA or a solo 401k plan and throttle it down based upon what's happening in your life. So if you can't do it in a single year, you're not going to be beaten up. The main thing, though, is that 30-30-40 or 40-30-30 approach. You do it in good and bad years, so that ideally you have that war chest available to you when things aren't going quite as well. So we have a lot of clients, even if they have a less than great year, less than stellar year, who can still make their retirement contributions, get the tax deduction and tax benefit because they set aside 40% the year before when things were good. So it's all about following the rules in good and bad environments that allow you to take advantage of the structures that we have put in place.
Yeah, and I can imagine those are difficult conversations to have with clients who are in a panic mode. If they're in entertainment and all of a sudden Hollywood shutting down, for example, hard to set aside that money that might still be trailing in, but if it's not going to be coming in for 6 months. But
fingers crossed, it's only 6 months. That's
yes.
That's the hard part. But it's all about planning ahead, not kind of expecting the next year to look like the last year. We deal with it on our ends, right? It had been a long time since we'd seen a real bear market that was persistent and lingered, and we just had one, right? You get brought back down to earth pretty quickly.
Right. Is it over? That's what everybody wants to know. Is it over?
Technically the how you define a bear market would say it is over. But is the volatility gone? To be determined. The Federal Reserve met yesterday and they're putting their odds of a recession next year pretty low. So this quote unquote soft landing may actually play out, which fingers crossed for all of us that's the case.
Yeah, well, that's why the Fed does what they do, and hopefully they've got people behind it. So yeah, exactly. So you started talking briefly about some of the different types of accounts, and I know some of them, correct me if I'm wrong, may vary depending on if you own an actual corporation versus being a sole proprietor. So maybe you can talk about some of the different types of accounts and how they apply and what the general benefits or drawbacks are.
Absolutely. So I think the main part of the whole conversation is, do you have employees, right? So if you're a doctor and it's a solo practice and it's just you, that opens up a lot of opportunities. But if you're a real estate agent, you've got a team of 4 people that are being paid out as W-2, creates a little bit of complexity. So the most basic retirement plan that's available to all of us, as long as you've earned income, is an IRA. Right? It could be a traditional IRA in which you're putting in money, you're getting a tax deduction on the amount that goes in. And that money, though, unfortunately, is capped. Right now, we're at $6,500. It's $7,500 if you're over the age of 50. That is available
annually, correct? That's per year. Yeah.
Yep. The nice thing about it is, the IRS accounts for the fact that we don't really know what our year is going to look like until the year is done. So you can make those contributions up until your tax filing deadline the subsequent year. The nice thing that's also available within that kind of entry-level retirement plan is the Roth IRA, right? So if you are a young up and coming, you could actually be an employee or employer, you can actually put money in after tax. It grows tax deferred. So you don't pay tax on it while it's growing, and it comes out tax free. So that's a huge benefit. We always tell clients, hey, basically the only way for you to hedge the fact that we don't know what taxes are going to look like in the future, right? We know what your tax bill is going to look like today. There are caps on the income level to which you can put into a Roth IRA, but it's always a great offering, especially for young people starting out. From there, we really take it up a notch, right? That's the training wheels into retirement savings. The two big ones for self-employed or business owners are going to be your SEP IRA or your solo 401k. From 30,000 feet, they look very, very similar. But as you get closer and closer to them, there's a lot of differences in complexity. And a lot of people spend a lot of time weighing what's more advantageous. So SEP IRA is very similar to a solo 401k. You put $66,000 in a year. But for the SEP IRA, though, it's capped at 25% of your earnings. So it's the lesser of the two. So if you make $1 million, you're going to run into that $66,000 limit. You get to discriminate a little bit if you do have some employees, and discrimination in a way of just saying, if you've got seasonal employees, there's ways to make sure that you don't have to put in that same 25% number for them. But if you do have full-time employees, though, you are going to have to match on a percentage of income basis. So not super advantageous for the employee, the employer type of business owner.
Right. So what you're saying, just to clarify, is that if you, as the business owner, want to take 25%, you have to give 25% of the other employee's income as well.
Exactly.
Got it.
So, if you're taking 5% because you made so much in a single year, you're going to have to also do the 5%. So that percentage number is going to follow you around.
Right. And does the employer have to pay that on behalf of so the employer puts in 5% or 25%? Okay. Got it.
So if you're an employee and you find out your employer has a SEP IRA, you're cashing in because there's very limited they can do to discriminate you. And you're going to get the same percentage contribution that they are. And none of it comes out of your pocket. So not super ideal in that regard. The solo 401k is most people's first choice when, especially if they're working with an accountant or an advisor who can kind of walk them through the nuances, because it allows you to put more in faster. So a solo 401k means I'm a solo single employee of my own business. I can go to a Charles Schwab or a Fidelity or other custodians who will, quote unquote, administer the plan. So they'll just make sure that I'm kosher with the IRS and the other regulatory agent, ERISA. And from there, you put in an employee contribution. So that is coming out of what you're paying yourself as like a W-2. So like your salary. And then you have the employer contribution. The limits that you can put in at the end of the year, same as the SEP IRA, the $66,000. The nice thing with both now, the SEP and the solo 401k, is Roths are now available in both, which is actually, the SEP piece is brand new. It's so new that a lot of custodians don't even know how to set up the accounts yet. They don't even offer it. Right. But on the 401k front, that's a huge piece. Now, a lot of our clients say, well, how do I choose between those two if those are what I want to do, right? It's just me. Maybe it's me and my spouse. How do I choose? Well, we know that we're going to be able to get more into the 401k more quickly, right? So that's kind of an easy one. A solo 401k is also great for that person with variable income because you can take a loan from it. Can't do that from a SEP IRA. Yes, the loan limits are dictated by the plan document that you sign up with whoever your custodian is, but typically it is up to $50,000 you can borrow from yourself, and you pay yourself back interest rather than having to pay it to some third party.
Yeah, we see that sometimes with clients who are looking to raise a little more capital. It's not going to move the needle that much, but if they need it to either, supplement a down payment or cover closing costs, or they don't want to finance over 80% and have mortgage insurance, they'll borrow a little bit from the 401k.
Precisely. And just saw a question from Shelly here. The time frame is typically dictated by the plan. It gets And this is where you want to work with someone who can explain a lot of this to you, because they do vary. There's even funky rules that you have to pay yourself back in equal increments. So you can't put in $3,000 today and then next month put $1,000 in.
Right. And just to clarify, the question was for the audience that's listening to audio only, what is the time frame to repay the 401k loan? Sorry to cut you off there.
No worries, no worries. That's very, very important. Is that time frame will be dictated by your document that supports the plan. If you go to a Charles Schwab or Fidelity or E-Trade or TD, they have default plan documents that will have a section that covers loans. For larger, more successful businesses, typically they will go create their own loan document with a third-party administrator, and that loan document will govern their 401k plan, and they can customize to the within the extent of the law some of those aspects like the loan. One thing to note, so a SEP IRA, that's $66,000 or 25% of your earnings that you could put away. You have up until your tax filing deadline to make that contribution. It's not a requirement, but you have the ability to do that. So if I'm a real estate agent, we're in 2022 or 2023, the market is volatile, that put that lightly. It gives you the opportunity to say, you know what, let's see how this year plays out. And then as I start to do my taxes, I understand what my tax bill is going to be. I understand what my property taxes on my own personal properties are going to be. What do I have left over? You can make that contribution then. The solo 401k is made in two contribution parts, right? So you have the employer and you have the employee. The employee contribution on a solo 401k has to be made by year end. So that portion of the contribution, which is pretty substantial amount that you can make to get you to that full 66,000, you have to make that decision before the year is done. So right. That can be, it's a devil and a curse, because it gives you the ability to put more in earlier, but at the same time, if you're not mentally prepared and you don't have your tax plan already done, it could be an obstacle. So that's important to know.
Yeah, and I would guess that most people in my industry are trying to grind through the last few weeks of the year to try to close transactions, and they're less focused on retirement planning, I would imagine.
And I think that, following the very simplistic, 30, 30, 40 or 40, 30, 30 structure, right? At the end of the year, you've put away money for taxes. You have put away money for your living expenses, and probably, hopefully haven't spent all of it, but most likely have, because, we live in expensive places. But you still have that savings bucket. And so that savings bucket is your wiggle room. It's, property taxes, I got to pay those from somewhere. It is, maybe I didn't quite put enough away for my taxes this year because I had more success than I thought originally. But it also allows you to say, okay, what do I need to have liquid? So outside of a retirement account, and then what can I put into the retirement account? And as you get close to that tax filing, whether that be in March or April or after the summer, you can assess, okay, I've got this extra amount of money. I can make the full contribution, or I can make a partial contribution.
Yeah, and I would imagine that gives you a lot more flexibility if you can do it after the tax filing deadline, because you can also see how the beginning part of the next year is going. So if you end up contributing that money toward a retirement plan, knowing that you've already made a good amount of money, or maybe not so much money, you adjust it the other way, it really probably gives you a lot of flexibility.
Or if you don't have if you have a property that closes January 15th, some of those proceeds you can use for your contribution in the previous year.
Right.
So yeah, it gives you a lot more flexibility on that end.
Just make sure you set aside some of that for taxes too, before you make the contribution.
Exactly. I won't touch on this too much, but if those, so we had like the very simplistic IRA, then we had the a little bit more complex but higher contribution limits in the SEP IRA and the 401k. A 401k, you will also, if you're hearing people like me who forget that other people don't do this every day, we'll also call that a profit sharing plan. There's another basket available, and it's typically, what we would consider the holy grail of tax benefit and retirement savings. And those are typically what we would call defined benefit plans. So a defined benefit plan used to be called pensions. A lot of our parents or grandparents had the benefit of working for large institutions that paid you a pension. Well, because those became really, really inefficient for the business and stockholders didn't love them because it weighed on the balance sheet, very few people started offering them anymore. But if you're a sole proprietor or an LLC S Corp individual, you don't have employees, the only person you have to worry about is yourself. So we have a lot of clients, especially those who are high earners, who will set up a defined benefit pension plan because the contribution caps are excessively higher than a SEP or a 401k, to the magnitude of 6 figures of contribution, which will allow you to get the tax deferral there and the tax deduction. There's different types of plans. We don't need to really get into the weeds on those today, but for the older individual who's looking to make a significant impact in their retirement savings and they have extensive income that is more predictable, a cash balance plan or a defined benefit cash balance plan or a money purchase plan can be a really viable option.
Okay, great. So one thing I also want to ask you about is a lot of people in real estate and entertainment and a bunch of other fields kind of have this point where they've got to decide, okay, am I going to continue filing as a sole proprietor and getting paid as an individual, or should I form an S Corp or an LLC or some sort of entity? So from if we're just looking at from retirement planning perspective, is there a reason why, in your opinion, that people should potentially consider creating that corporation to get paid through?
So not as much from a retirement plan perspective, but let's call it good housekeeping, right? So I always talk to my business owner clients that there's 3 primary tiers to being a business owner. There is entity formation. A lot of people do it from the inception. A lot of people outpace their level of success in their own planning, and they end up with a very successful business without any entity really established at that point. But entity formation is very, very important. What a lot of people do is they will set up a limited liability corporation, and from there they will still want to be paid as if they're a sole proprietor. So they'll make an S Corp election, which means you're not being taxed like a big corporation, which in a lot of ways is double taxation. But they'll make the S Corp election, which passes through them. There's liability protection there. There is tax benefits as far as shielding some of the income from payroll taxes. But there's also the creativity that you can utilize when utilizing an S Corp versus just being a sole proprietorship. Liability protection is paramount. There's one thing to note, and a lot of people always miss this, and I always hear people, if I'm at dinner and someone's talking about setting up an LLC, there's certain businesses that can't set up LLCs. So for example, if you are in the medical field, you cannot set up an LLC. You have to set up a professional corporation. My wife is in the medical field. We had to do that. It's very, very common that most people miss that. It's just because of the structures that the state or the federal government allow. But also, once you get through entity formation, it's setting up retirement plans. So SEPs, solo 401ks are allowed under sole proprietorship and an LLC. So there's no real differentiation there. But a defined benefit pension plan is not allowed under a sole proprietorship. So those are 2 elements to have the entity kind of working for you. And then I always remind people that, your business, if you build it right, lives on after you. So there's always the exit type of strategy. And, nowadays where brand and marketing is such a key component of most people's success, a lot of brand companies can actually outlast. So whether you have a successful team as a real estate agent and you've built a branding machine, that thing should be able to last after you're gone. So what are the exit opportunities there? And there's actually retirement plans called an ESOP, which is a way to sell your equity to your, second generation. It's an ERISA retirement plan, but you're being able to capitalize on what you built and keep it going. So those are the 3 tiers. Formation. So highly recommend reducing your liability. LLCs are key. Getting the retirement plan in place, and then having a big picture view of what does the next 15 years look like, and can I capitalize on what I've built?
Right. And sometimes the unfortunate situation happens where you're not planning to exit, but the old inevitable hit by a bus analogy can be important as well. And that's also why retirement planning and everything else is so important, because it also theoretically passes on to your family in those types of situations. So,
and I think, just a sidebar on this one, because it is it's probably the one that gets forgotten the most, is if something happens to you and you don't have a succession plan within your business, what is there any real value that you're leaving to your heirs, your spouse, your children, if that business is just going to lose customers and basically be depleted? So a lot of times what we'll do is we'll have a buy-sell agreement with yourself and one of your partners, to where if you do get hit by that big blue bus on Wilshire Boulevard, what happens next? Well, you have a life insurance policy that's owned by the business. The proceeds go to your business partner so they can buy it from your spouse, or they go to the second generation so they can buy the business from your spouse. And that way your spouse is getting compensated, but the business can live on, and it protects all those people that you potentially employed.
Okay, so I want to switch gears a little bit, because a lot of our clients have, they're either in marketing or entertainment or, I don't know, some sort of creative field where they're getting paid based on whatever the job is that they've been hired to do. Some of them are W-2, some of them are 1099, some of them through placement agencies. Like, there's no real consistency, which creates a challenge for lending purposes when you're going to get a mortgage, but that's not what we're here to talk about today. But from a retirement planning perspective, what do you do with somebody like that? Like, if they're, on long-term freelance projects and maybe they're part of the benefits program for a period of time, but then that goes away 6 or 12 months later, and then they're Schedule C 1099 again, and then, it just switches back and forth. How do you adjust from a retirement planning perspective?
So it's kind of a unique scenario. It's one of the only scenarios where you can really double dip, right? So let's say you have a W-2 job, but you also freelance as a writer or marketing or creative. You can actually have a separate retirement structure on your side while participating in your W-2 job's retirement plan. So it seems like an unfair advantage. Obviously, you're spinning a lot of plates to be able to achieve it. So you're doing the work, but there is the advantage of being able to double dip. You can have multiple plans as long as there's no shared ownership between the two entities. So as long as you're not a shareholder of the W-2, you can achieve that. Now, freelance work, if it is solely freelance and you're kind of bouncing around, that's where having a single point of receivership. So you can do it as a sole proprietor. You can also do it as an LLC, where they send you your 1099 or your check is paid to your LLC. A lot of the creatives do this. And you can have a retirement plan that accounts for all of the income streams coming in. So, and again, it gets back to having a structure where you're putting money aside every time you're getting paid, so that the opportunity at the end of the year to make that contribution or early in the next year is still there.
Sounds good. Okay, now I'm gonna turn the mirror on myself, because I enjoy doing that and sharing things that I'm deciding or going through, trying to enhance my own financial wherewithal here. But let's take people who own real estate in an LLC. Right? That's the sole operation. I'm trying to see if maybe there's an angle here that I've never thought about before until this conversation. I always pick up some great nuggets of information on these sessions. I think I learn as much as the audience does, sometimes more, because I get to talk and ask my own questions. But let's say someone like me, right? I have a W-2 job. Unfortunately, my industry, you have to be on W-2, so not much flexibility there. But I own properties in an LLC that do well and have positive rental income. Could I potentially create a retirement plan through that LLC if it's, let's say, myself and my wife that own the ownership of that entity?
If we have any accountants listening to this podcast, they will be chomping at the bit for this one. So it's a very specific question, and we encounter it a lot, especially for individuals who are active in the real estate business in Los Angeles, but have a separate job on the side. Mm-hmm. So It depends on if
We're
you're
big proponents of side hustles, especially in
Exactly.
real estate. Because I do it myself and I've seen the benefits of it. So
I mean, it's long-term wealth creation. It is if you do it right, the hustle becomes a little less hustly at the end, right? It starts working for you and it does a lot of the work. So it depends. So if your real estate income is active, as in you are claiming to be a real estate professional and you're claiming that status on your tax return, that's active income. Active income is the phrase that triggers your ability to have a retirement plan. Most people, though, they're not claiming an active real estate professional status. They're taking it as passive income. Passive income doesn't qualify. And so, there are certain tests, and it's constantly coming up because, it's highly debated. But like what actually allows you to claim to be a real estate professional and have that separate business entity to do so? I think the number is 700 hours of work. But it's highly contested and highly debated these days of, what really qualifies, because like you said, you would be able to, in theory, if you had active earned real estate income and your W-2, be able to participate in two plans. It's just, can you check that box and will your CPA sign off on it?
right, yeah. And will the IRS come knocking on your door asking questions about, show me proof of your 700 hours?
Yeah, right, exactly. Yeah. Where were you on this date when you claimed an hour?
Right, exactly. You better start tracking your time. But if you have bad enough tenants, they drive you nuts for 700 hours a year. But
it gets really complicated where, we've had clients who are contractors who will be doing their own work on their own projects. Well, is that really separate from the contracting work? The best case scenario, I guess, is if you're like a heart surgeon, but you are also doing contract work on your own property and you're doing all of it on your own, then you should be able to differentiate, but it's a hard standard to meet.
Yeah, and hopefully that heart surgeon isn't putting 700 hours into real estate. They're saving lives.
Saving lives.
Yeah. Okay, sounds good. So any suggestions specifically, because we're going to wrap up here in just a minute, for the real estate community, for freelancers? Like, I mean, obviously we're big proponents of people getting professional advice and not trying to figure this out on their own. If there's anything, one of the things we've uncovered today is that there's a lot of options and a lot of little details that help you kind of decide how to figure this out. But do you have any just general recommendations other than, start retirement planning early? Don't start it when you're retiring. But to this community that's, may have variable income or up and down years or, anything like that, just general guidance that people can take away today.
Yeah, I think, and I'm not plugging myself here, I definitely think having a professional in your corner, whether it be a CPA or a CFP who understands these types of things, CFP being a certified financial planner, who understand these types of planning strategies, is, unbelievably beneficial, because it's a moving target. Every year there's tax law changes that will impact what you do. But I think the main thing is don't put so much pressure on yourself to feel like if you start today, you're going to be forced to do it in the future, because, life's not linear, right? Things change. Taking on some of these plans like the SEP IRA or a traditional IRA or solo 401k allows you to pivot, and it allows you to come up with, a plan for the previous year. And hopefully as you start, you'll come up with a plan for the next year. And so I think that's the main thing, is you're not locked in, but the sooner you start, because compounding is the eighth great wonder of the world, the better off you will be from a current tax standpoint and a future net worth standpoint. But yeah, I think it's a factor of put aside as much as you possibly can in good and bad years. Pay yourself first. We live in a place where unfortunately things are pretty pricey, so it's hard to do at times, but everything you can do allows you to improve your outcomes in the future and have more decision-making ability in the future. Yeah.
And one last question as we leave, because I think a lot of people, at least from my experience of talking with clients about all their financial details, when it comes to applying for a mortgage, but a lot of times I see people relying on their CPA only for these decisions. And I'm not sure, as much as I love the CPA community, and they're very sharp, very sharp. But seems to me like maybe that's going a little out of their lane on things that they should be advising on. Like, what's your take getting this advice from a CFP, a certified financial planner, or CPA? Is that a problem, or is it just that you might not have as much, expertise?
No, it's a fantastic question. And, I love my CPA community because they do everything I don't want to do.
Right.
So the way I look at it is CPAs, because of the dauntingness of their job, they pretty much focus 3 years backwards and 2 years forwards. It's hard to make a long-term retirement planning decision 2 years out. Right. So we need to make decisions that are thinking 10, 20, 30 years into the future, and even into potentially into the next generation. And so we will see a lot of opportunities because, from the financial planning standpoint, that, an accountant typically won't, because they're going to look 3 years back and think 2 years forward. So I think there's a lot more scope that having a planner in your corner can provide, and also help you see the big picture. I work with a lot of CPAs. They're typically not doing financial projections to show you the long-term benefit of compounding and being able to take tax benefits in subsequent years, which is something that we do on a daily basis. So whether it be just, utilizing someone to get a financial plan to be able to see how these things play out, I think it's worthwhile, or having someone in your corner, every day of every year can be highly beneficial. But it is most of the time outside of the scope of what accountants, I think, want to do. And two, really should have to do, because their job is to make sure that you don't get audited. And if you do get audited, that you're going to be in good shape.
Yeah, exactly. And I think a lot of people just don't. We hear about tax planning, and we know that like high net worth people that have the proper advisors are doing those things on a regular basis. And it's not just on December 30th. Right. They're doing it throughout the entire year. They're, maybe making their SEP plans, before they're filing deadlines. Like, there's constant tax planning. So I think this kind of alludes to the fact that you really need both. You don't, and we've been big proponents of people building a full financial team. It's something we're guiding our clients on, after they close, because sometimes you close on a mortgage, it's great. You have this great new home, but you don't have a will to say what would happen, who would it go to if something were to happen to you, or you don't have an estate plan in general, or, trust set up, or whatever it may be, to make sure that it's actually protected. So I think one of the takeaways here is that you need a full team, even though it sounds like, oh, I don't want to pay for a full team of people, but like some things could go really bad in an unfortunate situation. If you don't have those, you'll really pay for it later.
I mean, how often do we see clients take money from a brokerage account where they have a beneficiary and buy a property where they have no will and no beneficiary? So they take money out of something that has a very direct path to your heirs and goes into a place where there is no path. It's super common. All of our clients, even though we're not CPAs, we do have a team of CPAs, we're doing the tax planning that is 10, 15 years out. A lot of them have these projections, and it shows, at between retirement and 75 or 73, if it's current years, what type of tax strategy can we take to take advantage of the fact that your income will drop off and you'll now be in a lower tax bracket? CPAs typically aren't looking at that, because their job is to make sure you don't get audited this year. But we can kind of project that out in the future, and we say, hey, here's a huge opportunity that we're isolating and we're planning for. And I think having that team is so important. It's better not to make those mistakes. It's always easier to plan ahead, and having the right people in your corner is paramount.
Yeah, I would agree. We're big proponents of that, and some people think they're not ready financially to do those things, but the earlier you start, the more financially savvy you'll be. And
our industry's caught up to it
for the future.
Our industry's caught up to it, of what we call the Henry, right? The high earner, not rich yet. And the quote unquote, what is rich is always so subjective, but having structures in place to where we can say, hey, if you don't want to pay an asset-based fee because we're, most of your money's in a 401k that we can't touch, we can have a more creative planning relationship where there's a lower fee, but we can still get out ahead of this so that in 5 years, when your situation is significantly improved and you have significant wealth set aside, then we can come and have a more full-time relationship. But let's get these other things in place.
Right. Well, I think you've definitely given the audience a lot to think about and consider. And if somebody wants to get in touch with you, what's the best way for them to reach you?
Absolutely. You can get a hold of me on LinkedIn, Christian Hutchins, or you can shoot me an email, chutchins@lourdmurray.com. I live by my responses, so you'll hear from me pretty quickly. But if you have general questions, please feel free to pepper me and take advantage of my time. I love this stuff, so I'm more than willing to chat.
Yeah, well, we do too. Even though retirement planning doesn't sound that exciting, I always learn something, and this session has been no exception. So thank you so much, Christian, for joining us. To all the audience members, thank you so much for listening. If you are listening to the podcast version, please definitely give us 5 stars and a great review so we can get more people to find this session when they're searching for information. So we appreciate it. And again, just as a reminder, we have that $25 Amazon gift card we'll be doing the raffle for on August 1st. So if you can take a photo or share our information, tag us at the Bridge Loan Guy for Instagram or Mark Myman on LinkedIn. We will enter you to be a winner, and we will live stream that the raffle winner on August 1st. So thank you so much for joining us, everyone, and have a great day. Take care.